The time's come to do the allocation for my 2018 ISA. So I'm going to put 20k into the account and I'm going to adjust the weights based on new information. Now, a lot of you have said you'd find this useful because it's a very different process from starting out from scratch, because you already have a portfolio and you're going to add new trades to get you from where you are to where you want to be. So let's have a look at how we do that in a bit more detail, and I'll take you through it step by step. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So let's look at what's changed since the portfolio was created. This is looking at valuations across the globe using a measure called the CAPE price to earning ratio. And this is a measure of how expensive stocks are relative to their earnings over the past decade. Expensive is red and blue is cheap. And you can see that the US is very expensive and that Europe, and in particular the UK, look cheap. Looking at the global valuation picture in May 2018, the story hasn't really changed. The US is still looking expensive and the UK is still looking cheap, and Europe is somewhere in between. The reason why I look at the CAPE ratio as a measure of value is shown here in this report from Vanguard Research in 2012. The question is, how predictive are these factors of stock market returns over the next 10 years? And you can see the most predictive is a Shiller CAPE measure. If the R squared is 0, it's not predictive at all. If the R squared is 1, then it's perfectly predictive. And it's interesting that rainfall is actually more predictive than a lot of the other measures that people use, such as consensus GDP growth. But the Shiller measure is far from perfect. It still fails to explain 60% of the variation. And that's why this graph of the 10-year ahead return on the y-axis versus the valuation on the x-axis is just a kind of cloud of spots. But what you can see is that the cloud generally shifts downwards, which means that when stocks are expensive on this measure, the return over the following 10 years is generally low. When this report was published, the CAPE measure was around 20, but now the CAPE measure is over 30. So if we look at these two models that they offer, the PE1 and the PE10 versions of the CAPE measure, and we see what returns are implied, we can see that it's between 0 and about -2% over the next 10 years. And that's why I don't like US stocks. They've continued rallying and they've just continued getting more expensive. And history tells us that that suggests the returns will be very low over the next decade. Another thing I look at, which is in our newsletter every week, is the Purchasing Managers Index, because this gives you an insight into how businesses are doing and also how they see the future of their own business. Europe was very strong on the PMI measure when I created my portfolio. It's come down slightly, but it's still looking very positive. In the US, the tax reforms have made business much more confident and it's boosted growth. So the PMI has picked up there as well. So by this measure, the US is looking more attractive if it wasn't for those crazy valuations. Now, one of the things which is different this time round is I've incorporated the Vanguard factor funds. And the reason is I think this is probably the best way to beat the market over the long term. What I like about factors is that they're proven historically to beat the market. So you don't have to put your faith in a fund manager. Instead, you're saying that the future will resemble the past. And in this report, Vanguard lists 6 factors which historically have beaten the market. Size, so that's small stocks versus large stocks. Liquidity, which is stocks which are hard to sell or which have a low turnover. Value, which is stocks which are cheap, as promoted by Warren Buffett and Benjamin Graham. Momentum, which is stocks which generally tend to rally, but also volatility and quality. Figure 4 shows that this isn't going to be a smooth ride. There are long periods of time when these factors underperform. So you've got to be willing to take the rough with the smooth. So on the factor menu from Vanguard, there are 4 funds. Value, which screens stocks based on 3 different measures and then buys the highest scoring stocks. Momentum, which looks at 3 different measures of momentum and buys the stocks which are rallying based on those measures. Liquidity, which looks at 3 liquidity measures and buys the least liquid stocks. And minimum volatility, which looks at stocks which are low risk but also which diversify one another. And there are also things which haven't changed much. So I'm still using my Scooby-Doo tree. If you're wondering what on earth I'm talking about, you can watch my previous video But the idea is if you want to make sense of the Vanguard funds, you can look at their correlation structure, which is how they behave relative to one another, just as you would if you were trying to describe the cast of Scooby-Doo to someone. Here are the 5 characters, but on their own that doesn't tell you anything. But if I were to say that Shaggy and Scooby-Doo are the central characters and they're the clowns, that Fred and Daphne are the preppy leaders, and that Velma's the brains behind the operation, and that all together they form Mystery Incorporated, you'd have a much better idea about these characters and how they relate to one another. But the purpose of the tree is to avoid buying 2 assets which are highly correlated, such as the VUSA fund and the VNRT fund. Here you can see their daily returns plotted one against the other. When one rises, the other one rises, and when one falls, the other one falls. So they tend to double up each other's risk. They provide no diversification if they're both in a portfolio. Whereas the North America Fund versus UK Government Bond Fund are completely uncorrelated. The returns of one have absolutely nothing to do with the returns of the other. So if these two are in a portfolio, they'll diversify one another. What I've done is I've represented this as a tree, but remember the tree's on its side. And here it is. The names of the funds are on the right with their tickers. And those 2 funds that were highly correlated, you can see, sit together on the same branch. And if we have a 50-50 portfolio of VNRT and VUSA, the combined volatility is the same as the ingredients. There's no diversification at all. Whereas if I buy things from different parts of the tree, you can see these are quite different branches, VNRT and VGov. The combined volatility is very low. In fact, it's closer to the government bond than it is to the equity fund. So we've extinguished some of the risk in the portfolio by diversifying across this tree, using funds from different branches. So unlike last time, I'm going to have 6 funds in the portfolio, which means that I'll slice the tree just here into 6 different branches, which are color-coded on the right. The Scooby-Doo branch, which contains all of the energy of the portfolio, all of the upside, is the equity component. So these are all either global equity funds or equity funds which are outside the UK. And I'm just going to choose one ETF from this group, and that's the Vanguard Global Value Factor. And that's the new component of my portfolio. And I apologise for this, everybody hates Scrappy-Doo, but European shares are going to be scrappy. And in this branch I've chosen FTSE Developed Europe ex-UK. Scooby's sidekick Shaggy is UK mid-cap shares, that's the FTSE 250, and that comes with a fairly hefty dividend yield at the moment, which is very attractive. Fred's branch is 3 funds which contain dollar-denominated bonds, and in this group I've chosen VEMT, which is the Emerging Market Government Bonds. Daphne's Euro bonds, and here I've chosen European corporate bonds, and Wilma represents a safe and fairly low income but very diversifying UK government bonds, the VGov fund. So these arrows on the right show you the 6 funds which I've chosen to put into the portfolio. You can see that the star of the show over this period, from December 2016, is the Vanguard Momentum Fund. This has been a fantastic period for momentum investors who simply buy stocks which are rising. But the reason why I don't like this is because of the high correlation of global momentum to the US. The correlation is almost 90% because momentum has been focused on the US, with those fantastic tech stocks which have rallied very hard, but which now carry very high valuations. So as before, I'll take those 6 stocks and I'll put them into a risk parity portfolio, and that's the blue panel on the right. You can see that VGov has the biggest weight because this is still a very cautious portfolio. As a first step, I'm going to move the money from my current account into my Vanguard ISA account. So I go to payments. I could do it as a regular monthly payment, but instead of that, I'm going to do it as a single payment of £20,000. So I click on Add Cash, and I'll add £20,000. And at the bottom of the screen, a costs and charges disclosure has popped up. Let's take a quick look at that. And you can see that I'll be charged 0.15% on my £20,000, which is just £30 a year. And I'm very happy with that. So I'll go ahead and click on Debit Card. So I'll fill this in private and then we'll go back to the onboarding process. Okay, so we've added £20,000 to the ISA and now we can go ahead and invest it. If you do my asset allocation course, you'll get this spreadsheet. Now this is designed to help you rebalance your portfolio. The parts in yellow are the ones which you fill in. So you tell us about the broker trading flat fee or percentage fee, the stamp duty reserve tax, which in the UK is 0.5%, and how much new money you're going to put into the portfolio. So I've put in 19,700, and that's a little bit less than the 20,000 because I have to account for these trading taxes, which come to about £100 for this rebalance. And on the far right, you can see the trades which I'd have to do to get me from my current weights in column D to my target weights, which I've entered in column C. And you can see my new allocation, which is to the Vanguard Value Fund, here in row 20. And now we can implement these trades on the Vanguard website. The first fund I'm going to buy is the V-Mid Fund, which is the Vanguard FTSE 250 tracker. So that'll be in this list of 33 equity funds. And I'm going to buy £1,720 of that fund. And now I'll go through and add the rest of those trades. So here are the 6 trades that we saw earlier. You can see that the order status is pending because they haven't been filled yet. All we know at this stage is that they'll try and fill the order at the best price possible and the rough value of the trades. So here are the final weights. You can see that they're very close to the targets I created for risk parity. So that's how I allocated my 2018 ISA. I hope you found that video useful. If you did, then please consider supporting us on Patreon. It's really easy. You just click on the link and you can give as little as $2 a month, preferably $5 a month, and that'll help us meet our running costs and it'll ensure that we remain completely independent. We don't receive payments from any fund managers or large corporations. Now we've actually got enough Patreon supporters to read out from a list, so I'd like to thank Gintautas Jaroulitis, Louis Maire, Corn Dutois and Robert Guerrara, who are our current Patreon supporters. So thank you very much and thank you for listening.